I have been watching 5 mid-cap stocks whose fundamentals are looking strong, and they are from 5 different industries: personal care, pharma, finance, specialty chemicals, and agriculture. All these stocks which we are going to discuss are part of the Nifty Midcap 150 index. In 2023, the small and mid-cap indices have given more returns than they probably should have. So as of now, I don't prefer directly investing into those indices because the valuations are quite high. But if we have the skills to pick individual stocks, we do not need to worry about the valuations of the indices. So today we will be discussing 5 mid-cap stocks which can be good investments, and also 3 mid-cap stocks which I would like to avoid. Namaste and welcome to Retail Investing. Stock number 1 is from the industry of personal care and healthcare. And here is the chart. So the current market price is just under 500 rupees and the 200-day moving average is at 450, which is quite close to the current price. So there was some heavy buying in August, and after that the stock has seen some consolidation. So how exactly do they get their revenues? Well, they sell products like BoroPlus, Zandubalm, Dermicool, Fair and Handsome. They claim their brands are household names today, and I agree. So here is the financial overview. How much return can they generate on our capital? 28%. That is excellent. The price to earnings multiple is much below the industry average. That's good. And what about debt? Well, the company's debt is very low with a debt to equity ratio of only 0.04. So here is the profit and loss statement. And as you can see, the margins are nice, but the sales growth is poor. You see, without sales growth, investors' money cannot grow, no matter how big the margins are. So to improve their sales, they are making strategic investments into segments which are seeing good sales growth, as high as 63%. They have also acquired some stake in an Ayurveda company. So it looks like the company is quite serious about improving their sales growth. The name of the stock is Emami Limited, and please let me know in the comment section if you use their products. Stock number 2 is from the pharmaceutical sector. The Indian pharmaceutical sector's global ranking is 3 in terms of production volume. Made in India drugs are exported to 200 countries, and retail investors simply cannot ignore this sector. So here is the chart. Currently, the stock is trading at 22,600 rupees and the price is just below the 200-day moving average. It is a very volatile stock, and the reason is that the trading volumes are quite low, and this means it can easily correct from the current levels. I personally like volatile stocks with good fundamentals because they give us buying opportunities over and over again. So let's find out whether the fundamentals are good or not. So here is the financial overview. How much returns are they generating on our capital? 41.1%. So this can be an indication of some kind of a competitive advantage. The price to earnings multiple is a little above the industry average. The debt is very low with a debt to equity ratio of only 0.03. So here is the profit and loss statement, and as you can see, the margins are excellent and growing, but the sales growth is the same as the industry average. So how do they expect to increase their sales growth? The union government has a health insurance scheme known as the Ayushman Bharat Prime Minister's Jan Arogya Yojana. So this scheme is going to enable a lot of people to gain access to healthcare, and private clinics are likely to benefit. The name of the stock is Abbott India Limited. Stock number 3 is from the fintech sector, and the company provides loans and facilitates online payments. And here is the chart. The all-time high is 2000. Recently, the stock crashed to levels of 600 and a fast recovery is going on. The RSI indicates extreme overselling. You may have guessed it right. The stock is Paytm, and it recently crashed due to some policy changes by the Reserve Bank. Previously, lenders like banks and NBFCs who wanted to give a loan of say 100 rupees had to set aside 8 rupees. This 8 rupees would be a security against the risk of defaults. And now, after the Reserve Bank's policy change, they have to set aside 10 rupees for every 100 rupee loan. It's a huge increase of 25% in provisioning. The result of this policy change will be that less loans will be given out. The majority of Paytm's loan book is made up of small loans of under 50,000 rupees. And now the management has decided to change their strategy and make loans of 3 to 7 lakh rupees their priority. So Deep asks, the stock ran up 30% and sustained 880 to 900 levels for 6 months. What was the reason for the run-up? Did Paytm actually give out low-value loans to substantiate this growth? Any numbers to back up the growth and the fall? Well, as per the official numbers reported by Paytm, the company did give out those 50,000 rupee loans, and those reflected in their revenues. Their auditor has not raised any concern regarding any kind of fraud. So the reason for reaching 900 levels was quite obvious. Their losses are coming down and they are getting closer and closer to generating positive cash flows. As you can see, their per share loss was 688 rupees in 2019 and now it is only 20 rupees. So Paytm has two main business segments, payments and loans. The payment segment is a low margin business and the loan segment is a high margin one. So it makes sense to focus on giving out bigger loans. Price targets of 1000 plus have been given by some professional analysts, and the highest target for Paytm that I have seen is around 1300. 2024 is likely to be the year when Paytm turns cash flow positive. And in a low interest rate environment, I would not be surprised if Paytm hits those price targets. Stock number 4 is from the chemical sector. And here is the chart. The IPO happened in 2021 and the listing price was around 1750 rupees. From there, it touched a high of 2700 and from that high, we have a correction of 50%. So why it corrected so much? Did the profits go down 50% as well? We are going to find that out in a moment. But before that, let's get back to the chart. If you look at the RSI, you can see that there is a clear trend of overbuying and overselling since the IPO. And as of now, it is close to being overbought. I think 1300 to 1400 would be very good buying levels for this stock. So how does the company get their revenues? Well, they make specialty chemicals. I will share the categories of specialty chemicals they make, and you can research their usages if you are interested. So here is the financial overview. How much returns are they giving us on our capital? 44.5%. I am very impressed. The price to earnings multiple is almost double the industry average, and that is not cool. But it is a debt-free company, and that is really nice. So here is the profit and loss statement, and as you can see, the margins are very, very impressive. But in the last 12 months, the sales have taken a hit. The name of the stock is Clean Science and Technology Limited. They have recently completed some capex, so there is some optimism around it. Stock number 5 is from the fertilizer/agriculture sector, and here is the chart. The current market price is 1231 and the 200-day moving average is at 1030. In October, there was a significant correction and the recovery happened pretty fast. The RSI is at 60 and I'd like to buy when the RSI comes down to levels of 40. I know it is the exact opposite of what some momentum traders do. The trading volumes of this stock are high enough to make it a stable stock. More than 50% of the population earn their livelihood from the agriculture sector, which means a lot of votes come from the agriculture sector. And that means government policies are likely to favor the agriculture sector. There is no reason why retail investors should not look for investing opportunities in this sector. So here is the financial overview. A market cap of 36,000 crore rupees. The current market price is almost at its 52-week high. I would be a little careful about that. The price to earnings multiple is still quite low compared to the industry average. Now the most important question. How much return can they generate on the capital invested? 38%. Very impressive. It's an almost zero debt company with a debt to equity ratio of only 0.05. The name of the stock is Coromandel International Limited and they make fertilizers and nutrient products for the soil. Now let's talk about the 3 stocks from the Midcap 150 index which I would like to avoid. Number 1 is Page Industries. Page Industries has the exclusive license to manufacture and market jockey undergarments in India, the UAE and few other countries. This stock has created fortunes for many investors, but the best days are clearly gone. So Page Industries has consistently compounded investors' wealth for more than 10 years starting from 2010, but now it looks like the fire has run out. Recently, Page Industries has made investments in improving their technology and improving their distribution system, which could yield results a few years later. But as of now, the valuation does not seem right. If you take the estimated earnings of financial year 2025, it is trading at a price to earnings multiple of 55, which is quite high. And I do not expect anything from this stock until 2025. Stock number 2 that I would like to avoid is TTML, Tata Teleservices Maharashtra Limited. If you are familiar with this stock, it is likely that you have lost money in the stock back in 2021. If any of you guys are still trapped in it, please let us know in the comment section. So here is the chart. As you can see that in between September 2021 and January 2022, the stock went from around 30 rupees to 300 rupees. That is 10x returns in just 4 months. So the question is, why would I want to avoid stocks like this one? Well, it's because when they come down, they get locked in lower circuits and retail investors do not get any chance to sell their stocks. That is exactly how stock operation works. Few days ago on 18th December, there was a sudden spike in buying volumes. So my dear retail investors, Please be careful. And stock number 3 from the mid-cap 150 index that I would like to avoid is Rajesh Exports. This stock crashed from a high of 1100 rupees to levels of 350. The company processes more than 35% of the gold produced in the entire world. So is it an undervalued opportunity? I don't think so. A good gambling opportunity? Maybe yes. You see, value in a business comes from cash flows. And cash flows come from profit margins. Rajesh Exports has close to zero margins. Tomorrow I can start a business with only 2 products, Kali Chai and Parle-G biscuit, and still have better margins than Rajesh Exports. So I am out. Please let me know in the comment section what do you think of these mid-cap stocks. And don't make any investment decision in a hurry based on what you saw on YouTube. Feel free to do a little bit of your own research as well. If you want to know the names of some unknown stocks owned by the rich people, you can watch this video. Thank you very much for joining, and I'll see you in the next one. Jai Hind.